live from CNBC TV 18's headquarters in Mumbai. This is Opening Bell with Udayan and Mukherjee.
Good morning. Welcome to Morning Call. What a closing we had on Friday. If you were hoping that 5700 would hold out or 5750 on a closing basis, this was one shocker. So all those levels have come and gone, and now you cling to other levels like the 200-day moving average and figure out where this market's going to stop falling and whether the market's priced in and much of the bad news that maybe analysts can't see coming, but the market has sussed out for 2011. So these are tough days for the market. The year has begun really badly, and it got a whole lot worse on Friday. The Nifty got a haircut on Friday for sure, as it seems my co-anchor as well. Mithali, morning.
I'm instituting the lame joke award, and you're in pole position, Udayan Mukherjee. But last week was like one of those horror films where you just can't bear to watch, and it just got worse and worse.
Yeah, and Friday was terribly. I think it was a fairly debilitating kind of blow for traders. The way the market flattered in the morning, went up to 58.50 thereabouts, and then collapsed to 56.50 by closing. Despite inflation numbers coming in pretty much in line with expectations. So I think Friday would have put a lot of scare into people in the market, and that's what we've been talking about, Mithali, over the last few days, that it's not a good idea to trade this market. The average volatility on an intraday basis is 200 points on the Nifty, and I think it might be killing a lot of people out there with the sharp intraday swings. Not just Friday, you saw it at least on 3 occasions during the week where the Nifty went up 100 points and then fell 100 points intraday, and that kind of thing just gets traders out of the market quite completely if you're on the wrong side of the trade. Now, I think the market is probably, we started the year with a lot of talk about 15% market growth and 20% earnings growth, and I think what the screen has consistently told you over the last 2 or 3 weeks since the start of the year is that, guys, you need to just lower your expectations and estimates because there's something in the environment that you have not priced in. I don't know whether the blinkers have gone now and people have come to terms with the fact that 2011 might be more challenging than they thought on the 1st of January, and how much of that has got priced in is the material question for investors, because at this point I think a lot of people, and correctly so, will be looking at opportunities to deploy capital, and they just need to fine-tune a little bit to see how much of the bad news in individual sectors like banks, like autos, like construction have got priced in, and whether the time to buy has come in. I think that's the material question for investors. For traders, if they're still in the market, they better be careful.
But it's also disturbing, Udayan, to see underperformance to this degree. I mean, last week markets are up 2%, we're down 4%. Markets are up 5%, we're down 8% for the year.
Yeah, that's the problem, and I think it's increasingly looking like an emerging market issue, Mithali. India is standing out with its underperformance over the last couple of weeks, no question about that. But even China is not doing a whole lot. So, if your money is lying as a global investor in an emerging market fund or a BRIC fund, or you were running India ETFs, you would suddenly start now wondering, what am I doing with money in that region, because these markets are just not performing. While the S&P is trading at 2-year highs, the CAC and the DAX are running away, and the divergence over the last couple of years, compressed in a 15-20 day period, is quite sharp between developed and emerging markets. So I think now this whole inflation scare has got into Asian market performance, and I don't know what that means for capital flows. Of course, extremes happen when such views are taken, but you're right in pointing out that this underperformance cannot be going unnoticed for a large number of investors who put money to work in this part of the world over the last 12 months.
There was worrisome, Udayan, because it got that whole relative resilience argument, at least it threw it out the window. It didn't look like the market had any strength in it.
No, and it was a matter of time before 5700 broke, Mithali. But there was at least 3 hits against that support level. It was getting weaker, and frankly, in this kind of environment, despite a lot of calls from chartists saying 5700, 5750 will hold out, you can't ignore fundamentals beyond a point. So, and I think that's the realization which a lot of people have to come to terms with, because all of us have been spoiled by this kind of smooth move that we've seen over the last year or 15 months in the market, where everything has followed a pattern. Corrections have not been more than 8-10%, and whatever was regarded as a support level has always held out. So the Nifty was moving in staircase pattern and perfect staircase patterns of 800-900 points in one go. It would take time in a range, then it would break out, and once having broken out, it would never go back and form a lower low. And that was a nice trending market with no great momentum. But now you can't ignore the fact that a lot of fundamental factors around us seem to be changing for the first time in many months, and the market's taking note of that. So if you then sit on your high stool and say, I will just go with the pattern of the last 6 months because that's worked as a trading pattern, I think you would be making mistakes, as traders would have over the last few weeks. When things start changing fundamentally for a market, then levels are not very important. Levels are important, technicals are important in markets where there are nice trends, and I think in the near term you can see that the trend is in danger. The intermediate trend is in danger, not the long-term trend. So I think it's quite possible and likely that at least 5400, I mentioned that level because that was the level which the market took a very long time to break out of. So it's not like a DMA or anything like that. It is a psychologically very important level for the market to hold as well, and I think a retest of that is quite likely. Now whether we now go to the 200 DMA, which is 5600, and then having fallen so much, we do a rebound and get back to 5850, 5900, and then resume a down leg which takes us to 5400. Those are very difficult things to map, Mithali, and even more difficult to trade. So I would trade with a lot of trepidation at this point in time. The more material question is how much of what the market is apprehensive about for 2011 has been priced in already, and how much of a surprise still remains in the kind of growth and earnings damage which might come about, which is not penciled in by analysts today. I don't have the answer to that clearly, but I think the market's quite apprehensive, and between an analyst Excel sheet and the market, I would go with the market any day.
You can see it in the internals though, then the market is coming around to the view that 5500 is going to come up to get tested. The money outflows have started widening now, at least Friday's figure has.
Yeah, the money issue is going to bother us for a while, Mithali. I think in that you need to distinguish between what is going on in the market. This is not a 2008 kind of sell-off because everybody and his uncle was in the market doing futures and options. The market was extremely overextended technically. So when the fall happened, you lost 50% like that because everybody was scrambling to cover up a leverage position in the market. Today the problem is different. It's a slow poisoning, it's a drip poisoning kind of environment where nobody has that kind of leverage, which is why the market is not falling 20% in a week, but it's just grinding on the way down because there is a lack of buying, and a lot of people who've invested in India over the last few months or last couple of years are slowly beginning to cut their weightages and pull money out of this market. So I don't know which is better. You can take comfort in the fact that this is not a one-way kind of fall and it gives people a chance to exit. On the other side, this might stretch out a bit in time. You might get this grinding 700, 800 crores a day for a protracted period of time, and the market might be completely sapped on the way up. So you might not discover great momentum on the way down, but this is the kind of market which caps upsides and probably keeps grinding to slightly lower levels. So I think it's a frustrating market in that. On the option side, I think people are just reorienting every week their bands lower, and now 5400 puts are quite active. I'm surprised to see that 5700 calls are getting written as well, but I don't know whether that means that the market feels or participants feel that we get stuck in a 54, 5750 kind of a range for a few weeks. If that pans out, that will not be a great outcome.